Welcome back to The Explainer. Today, we're unpacking a truly bizarre financial paradox. You know when you hear a piece of undeniably good news, but everyone around you just instantly starts panicking? Well, that is exactly what happened recently on Wall Street. We're going to look at a day when the stock market crashed, not because the economy was falling apart, but, ironically, because it was doing way too well. We're calling this the good news paradox. And by the end of our time together today, you're going to understand exactly why the market reacts this way.
So it all started first thing in the morning with the release of the May U.S. jobs report. Now, going into this report, economists had set their expectations at roughly 80,000 new jobs. But then, bam, the reality hits the screen. The U.S. economy actually added a staggering 172,000 jobs. I mean, that's literally more than double what was expected. At the same time, the unemployment rate held perfectly steady at 4.3%. By all traditional measures, right, this signals a remarkably healthy economy. More people working generally means more income, more spending, and just a robust economic engine overall.
But, okay, here's where the paradox kicks in. You'd think investors would be popping champagne, right? Nope. Instead, the markets absolutely tanked. Almost instantly, we saw this massive sell-off. The tech-heavy Nasdaq dropped almost 5%. And the VIX, which, if you don't know, is essentially Wall Street's fear gauge, that spiked 39% on the day. Just a total sea of red. Okay, let's dive into this and solve the mystery. Why on earth would stellar employment news, a sign that everyday people are actually getting jobs and making money, cause a violent crash in the stock market? To figure this out, we have to look past the flashing red numbers on the stock exchange and focus on a totally different part of the financial system. Section 1. The hidden engine. While stocks are flashy, exciting, and frankly a lot more entertaining to talk about, they don't actually dictate the rules of the game. To understand this crash, we've got to look at the bond market. The bond market is often overlooked by individual investors, but whether you're buying stocks, buying a home, or running a business, the bond market matters to you. And the key metric here, the bond yield. Simply put, a bond yield is the return an investor realizes on a bond. But here is the absolute critical rule to remember. A bond's yield moves inversely to its price. Keep that tucked in the back of your mind, because it's the secret to unlocking this whole paradox. Almost immediately after those 172,000 new jobs were reported, Treasury yields across all timeframes just spiked sharply. The 2-year yield rose significantly, the 10-year yield jumped to its highest level in several weeks, and the 30-year yield, straight up. This wasn't a coincidence. It was a direct, immediate reaction. To understand exactly why those yields shot up like a rocket, we have to talk about the most powerful player in the room. Section 2, the Fed's balancing act. That most powerful player? The Federal Reserve, of course. For years, they've been walking this crazy tightrope, trying to bring inflation under control without accidentally triggering a severe recession. So for a lot of this year, the market has been desperately looking for signs of a gradually cooling economy. Nobody wants a total collapse, obviously, but investors wanted things to slow down just enough to ease those inflationary pressures. Why? Well, because if inflation cools down, the Federal Reserve has way more room to lower interest rates. And lower interest rates are fantastic for investments. They boost stock prices, make existing bonds more valuable. It was the dream scenario. But that massive 172,000 jobs number threw a massive wrench into the story. Because instead of a steadily weakening labor market, employers are still out there hiring at a very healthy pace. And that triggers what we can call the inflation loop. Think about it. When people have jobs, they earn income. When they earn income, they go out and spend that money. Businesses see stronger demand and gain better pricing power. Plus, when employers have to actually compete for workers, wages naturally rise. This entire loop means one very, very frustrating thing for the Federal Reserve. And this brilliantly illustrates exactly why the market panicked. A strong labor market isn't a bad thing for society. It's great, but it makes the Fed's job of fighting inflation incredibly complicated. When investors saw that jobs report, they didn't wait around for absolute certainty. Markets are fickle, you know? They react based on probabilities. And suddenly, the probability of near-term interest rate cuts looked less and less likely. Investors realized the Fed would have to stay patient and just keep rates high. Section 3. How bond yields work. So if the Federal Reserve might keep rates higher for longer, how does that directly cause those bond yields we looked at earlier to spike? Let's debunk a major myth right now about how the bond market actually works. One of the most common misconceptions is that bond yields just blindly follow whatever the Federal Reserve is currently doing. Actually, scratch that. It's not true at all. The reality is that bond yields are largely driven by expectations about the future. When investors buy Treasury bonds, they're making a judgment call about where economic growth, inflation, and interest rates are likely to be over the entire life of that specific bond. Let's do some quick visual math to see how these expectations play out in real time. Imagine for a second that you currently own a Treasury bond and it pays you a 4% yield. You're happy with it. It's a solid, safe return. But suddenly, that massive jobs report comes out. Investors everywhere realize, uh-oh, the Fed won't be cutting rates anytime soon. In fact, rates are going to stay higher for longer to fight off that inflation loop. Because of this, the market fully expects that newly issued bonds in the future will just have to offer a better return, say 5%. So what do you think happens to the demand for your old 4% bond? Notice how these mechanics perfectly explain the market's reaction. If new bonds are going to pay 5%, absolutely no one is going to pay full price for your old 4% bond. Your bond becomes way less attractive. Therefore, the price of your bond falls. And because of that inverse relationship we mentioned earlier, remember that? As the price of existing bonds drops across the market, their effective yield rises. That is precisely why we saw yields spike the literal second the jobs data dropped. Investors were repricing the future. Section 4. The Ripple Effect. Now you might be wondering, okay, that's fascinating bond math, but I don't trade bonds. Why did my stocks crash? So the crucial point is this. The bond market doesn't exist in a vacuum. It is the foundational layer of the entire financial system. When Treasury yields rise, borrowing becomes more expensive throughout the whole economy. If you're a home buyer, you're suddenly facing higher mortgage rates. If you're a company, your financing and borrowing costs just jumped, which cuts directly into your profit margins. And for stock investors, well, higher yields mean they have a safer alternative to stocks, so they reassess how much they're actually willing to pay for future corporate earnings. And boom, stock valuations fall. This is a very, very important distinction to make. The bond market wasn't out there saying, oh no, the economy is too strong, this is terrible. Nobody actually believes healthy job growth is bad. What the market was essentially saying is, okay, the economy is strong enough that the Fed has to keep interest rates higher for longer than we hoped. It wasn't disappointment in the economy itself, it was disappointment in the timeline for those rate cuts. Section 5. The chain reaction. We've covered a lot of ground here today, moving from jobs data to inflation loops into bond math, and finally to stock valuations. Let's move to and see how this builds by summarizing the exact logical chain that caused the crash. Domino 1. We get a surprisingly strong jobs report of 172,000. Domino 2. That strong data leads investors to expect fewer rate cuts from the Federal Reserve because inflation might stay sticky. Domino 3. Fewer cuts mean expected future interest rates shift upward. And finally, Domino 4. Those higher expected rates cause current bond prices to drop and Treasury yields to spike, making borrowing more expensive and ultimately triggering a stock market sell-off. It really highlights just how interconnected and sensitive our financial system is right now. Market expectations are incredibly fragile, and investors are hanging on every single word from the Fed and every single data point from the labor market. Which leaves us with a critical question to ponder. If one single jobs report has the power to trigger this massive domino effect across bonds, mortgages, and stocks, what will the very next data drop do to your portfolio? Keep an eye on those bond yields, guys. They usually tell the real story. Thanks for joining me on this explainer, and keep learning.